The stock market has been off to a volatile start to 2025, with some up days, especially at the beginning of the year, but some really negative days too, including one of the worst days we've seen in the last 40 years. But now that most of the extreme volatility has passed, how bad are things really for Canadian investors? So today I'm going to go through how an aggressive, conservative, and a balanced investor somewhere in between might be faring this year to help you wade through the noise of what you might be hearing from friends or headlines in the media. Is your portfolio doing as poorly as they say? Well, let's talk about it right here on the Canadian Money Roadmap podcast. All right, welcome back to the podcast. If you've listened to the show for a long time, you'll know that I've been away for a little bit, getting settled in my new office. So this is not going to be my permanent recording space here, but I wanted to start putting out some more content and get back into the rhythm of doing this because it's been a long time. So I appreciate your patience and staying on as subscribers, and appreciate all the emails and contacts from you as listeners. It got me excited to come back and do the podcast and do more stuff just like this. And so, yeah, this is a temporary location here. Now I have a couple office spaces here, and I'm going to turn one of them into a more permanent recording studio. So things will change a little bit on a go-forward basis, but I'm really excited about that. And then before we really get into the content here, I have to go through all the disclaimers here, of course, that anything that I'm going to talk about today is not a recommendation of any specific investing strategy. I'm going to be using live data from real ETFs. So as we're going, the numbers are probably going to change. And by the time you watch this, the numbers are probably going to be different. Things change from hour to hour here. So by the time you see this, things might be drastically different. So hopefully take this with a grain of salt, but I'm just trying to give a bigger perspective than just the day-to-day. Yeah, it's only 4 months here so far, so it's not exactly a large sample size, but I just wanted to put the whole year-to-date here in 2025 into some context. So your situation is going to be different than what I'm going to be showing on here because you probably have different holdings. You might be contributing on a regular basis, which affects your rate of return. You might be withdrawing from your portfolio on a regular basis. Say if you're in retirement or you're using your portfolio for other things, your experience is going to be different. And, you know, if you sold at the bottom when things got really scary, or if you bought at the bottom, again, just doing the full swath of disclaimers here that what you see on here is not going to be your experience, but just a general idea. Okay. Another thing as well, this is primarily for a Canadian audience. So I'm using Canadian listed ETFs. I'm trying to use ones that are not Canadian dollar hedged. So there is a currency component to it. So what you see online, if you're just looking up a quote of what the S&P 500 is doing or whatever, it's going to be different than what I'm showing for the S&P 500 because mine is going to be purchased in Canadian dollars. And so the impact of the currency fluctuations will impact the rate of return there. So anyways, let's get into it right here. And I'll flip over my screen so we can take a look at some graphs and see what I'm talking about. Okay, so in the intro, I mentioned that the worst of the volatility is perhaps behind us. I'm going to quantify that here in this screen here. So what we're looking at is something called the SPX or the CBOE SPX Volatility Index. Oftentimes we call that the VIX. And what this does, it's a little bit complicated, but essentially it tracks the options pricing market. So essentially when people are looking for insurance on the downside, it increases the price of that insurance. We call those put options. And so when it increases the price of those options, the volatility index spikes, which means that people are more concerned about the downside. And so that was what we saw here on Liberation Day. I think President Trump was calling it that. People weren't exactly feeling too liberated, obviously. So here is the spike of volatility there. It closed that day at about a 52. Don't worry about the absolute numbers there, but where we are now is about half of where that was. Okay, so as you can see, the volatility can spike really quickly. And so when I say it's behind us, sure, that can change tomorrow or right away. But right now, volatility has come down meaningfully since then, so we're not seeing as many crazy moves day to day. But let's get into the specifics of a portfolio. Okay, well, let's first look at what I would call the most aggressive investors. These people would probably fall victim to what we call recency bias. So essentially buying the thing that worked the best most recently, assuming it'll continue to work the best. Who knows? We don't know what's going to work best in the future, but just choosing your portfolio based on the things that work the best most recently is not typically a great way to build a portfolio. But what we're looking at here is the NASDAQ 100 ETF and also the S&P 500 ETF. Again, these are in Canadian dollars. And what we've seen, this is year to date, so going back to January 1 up until right now. So the NASDAQ in Canadian dollars is currently down pretty close to 12%, whereas the S&P 500 is down about 9%. That is from the start date, not from the peak. If we want to see the peak, we can take a look right here. So from the peak, because the beginning of the year went up a little bit, if we're looking peak to trough, the drawdowns are closer to 16% for the NASDAQ and about 13% for the S&P 500. So that is meaningfully down from where it was at its all-time high. If we're looking at just year to date, just the returns from January 1 to today, it's not too crazy, but people often have that another bias here called an anchoring bias, where we remember how high it was versus where it is now. That's a really tough way to live, by the way, as an investor. So if you can kind of zoom out and see the bigger picture, that can often be helpful. So these portfolios would be more concentrated. And I say concentrated because they are just primarily in one country, that's in the US, and they're very heavily weighted towards what we call the Mag 7, or the 7 largest companies in there. And so these products invest more money into the biggest stocks. So as they get bigger, they become a higher weighting in the portfolio. And so those big companies, the tech companies in particular, the NVIDIAs, Apples, Microsofts, Amazons of the world, they will make up a disproportionate amount of these portfolios. Okay, so that is where things are at for people who looked back and said, I want to go hard. I want to invest in the US. I want to invest in tech stocks because it did really well recently. This is about as bad as it gets for Canadian investors. If you own individual stocks, if you own some crypto, I'm not sure where crypto's at right now, by the way, but there was a number of cryptocurrencies that were down about 50% over the last few months. But these are reasonable portfolios that I would see from time to time from people that aren't stock picking. They're trying to be smart by picking index funds, but they're perhaps not diversifying as much as I would maybe recommend. Now, if I layer in VEQT, so that's Vanguard's All Equity Fund, I've got a video explaining some of the features of that ETF, but essentially this would be an all equity single ticket ETF where it allows you to buy a pile of stocks from around the world. It includes some Canada, it includes some international, a bit of emerging markets in there as well. And when you add that diversification so far this year, that has helped. And again, this is just year-to-date numbers, but VEQT, as of this exact moment here on April 30th, it's only down about 3.5% so far this year. So again, if we're looking at the drawdown from the peak, it's down about close to 8% from that peak, but so far this year in 4 months, down about 3.5%. So things aren't too bad. If I zoom out just one stage further, over a 1 year basis, you're still up 11% over the last 12 months. That's going back to the end of April of 2024. So things are in really good shape. And what I have really appreciated this year is that diversification is working. So all the talk of tariffs and whatnot, it's impacting different countries in different ways, and many countries around the world are still very, very positive year to date on their performance, whereas the US is the primary country that is negative. They happen to be the largest stock market in the world, so that is kind of dragging some things down, and most diversified portfolios down with it. But anyways, that's where we're at with the VEQT portfolio. Again, it's about 30% in Canada. I believe it's about 50% in the US, and then about 20% elsewhere. The exact numbers are escaping me right now, but that's the ballpark. Now, forgive me as this chart gets a little bit more muddy here, but I started layering in the next phase down in terms of risk profile would be a balanced investor. And so I'm using Vanguard's product again, VBAL. So that is a balanced portfolio, about 60% stocks. It's in that same allocation that you'd see in VEQT, but they layer in 40% in global bonds as well. And so bonds have helped this year again as a diversifier. So a balanced portfolio like this one is only down 1.64% year to date. It's pretty manageable. That is, you might see a decline like that in any given day, but over the course of 4 months here, you're really not in too bad a shape as a balanced investor. The diversification piece has worked, so that's very reassuring. If we go out 1 year, you can see how the balanced portfolio hasn't performed as well. That makes sense because the last year in 2024, the most aggressive parts of the market performed the best. And so a balanced portfolio is just not going to be exposed to that much risk and potential upside. So the performance on a 1-year basis is going to be less. But if we're looking at the period of time where volatility was the most extreme, the diversification into the other asset class of what we call fixed income or bonds has held up so far. So that's got to be an encouraging piece for a balanced investor. Now, if you're super conservative and you only own bonds, this is Vanguard's global bond ETF. And you can see the green line here. It hasn't really moved a whole lot this year. And so, as a diversifier, you can see why that component of VBAL has really held up. It's up about 0.81% today. If we did this video a few days ago, it would have been flat to perhaps slightly negative. Now, bonds during 2022 really didn't do well at all. So if you've been a conservative investor this whole time, you're probably still down from where you were in 22 because of everything that happened with interest rates. When interest rates go up, bond values come down. So if you're holding bonds, the value of those bonds has decreased in value. So again, we're just looking at a very short-term timeline with a very specific start date. So if you've been holding any of these portfolios for any length of time longer than January 1st, your experience is going to be different. But this is just the pure performance of these products from this period of time. So I'm going to muddy the waters with another complicated chart here a little bit, but I thought you'd probably find it interesting to see what I mean by diversification is working. So these are some major markets from around the world. This is the year-to-date performance of those individual markets. These are looking at total markets. So again, S&P 500 is different than the total market. NASDAQ is different than the total market. So what you're seeing here in the US is different than what I showed before. That's partially the reason why, and also the currency factor as well. But if you look here throughout the Americas, these are some more emerging market countries. So you probably don't have a ton of exposure to Chilean stocks, but Chile is up about 24% this year. Looking over to Europe, Spain, Greece, Germany, Italy, they're all up over 22% so far. So global diversification has worked. A lot of these stocks were really, really cheap from these countries before. This is the idea of value investing, and that, when people have been nervous about investing in the US, they look elsewhere and they say, okay, where are some profitable companies in countries that have reliable governments and monetary and fiscal policy and all these kind of things, and are they going to be supporting other industries as well throughout these tariffs? Of course they are. And so countries from around the world are getting new flows of new investors' money, and stocks in these countries are performing really, really well. Nobody likes seeing their portfolio decline in value, and so anytime that happens, it can make people feel nervous, and that's totally fine. But I hope that today's video showed you exactly kind of where things are at. So for the average investor who's diversified beyond the US and beyond the S&P 500 and the NASDAQ, you're probably still in pretty decent shape. We are going to have declines throughout a year. It's very, very common to have declines of 10% or more in almost every single year. And so who knows where the rest of the year ends up. We could have a positive year here. Who knows what happens with these tariffs? We have a new prime minister now, so there's a lot of things that could still change from here. But as things are right now, if you're a stock market investor, if you're a bond investor, things are probably okay. If you're unsure of how you are doing right now relative to your goals, especially for a retirement goal, reach out to me. I specialize in helping people live fully and retire confidently. And the retire confidently piece is something that people definitely have on their mind right now, especially when the stock market is looking a little bit shaky. And so if you've never done a plan with a financial planner before and laid out how you're going to get to a confident retirement, reach out to me. I'd love to have a conversation with you. My contact info is in the show notes of this episode. You can find it here on YouTube, or you can find me at my new website at cedarpointwealth.com. Thanks so much for listening. If you're listening on a podcast or watching here on YouTube, I really appreciate you being here, and we'll catch you on the next episode.